Thanks, Simon. Morning, everyone. Hope you're all well. Just let me do the all this jazz. So, morning, everyone. Thank you to Hurst for asking me to speak again at this. It's a real shame that we couldn't be doing it face to face. I was really looking forward to coming in and having met a lot of you over Zoom over the last year or so. It would have been nice to see everyone face to face, but we live in hope that we can do that over the course of the next few months. So just a reminder for those of you who haven't met me in the past, my name's Alex Brandreth. I'm the Chief Investment Officer at Luna. Luna is a relatively new firm. We'll touch on that shortly. I'll just explain who we are, just a quick reminder. The other key topics that we're going to go through today is what's going on in the global economy. And it might be a little bit repetitive in some ways, but it is all about COVID. It's all about the vaccine rollout. It's all about cases. It's all about how different economies are evolving and changing to that. More recently, we're seeing a pickup in inflation as well, which is causing some comments and some concerns within some investors as well. So we'll touch on that. We'll bring it a bit closer to home and just talk about what's going on with the UK. Clearly, the UK is a little bit ahead in terms of the vaccination rollout, reopening the economy, but there's also some other points to go through and just talk about furlough and the housing market as well. The housing market has been on fire over the last year or so, and we'll just touch on some of the reasons behind that. And then we'll just end up with some final remarks and questions towards the end, as Simon mentioned. So just a little bit on Luna. So Luna's a firm that started a year or so ago in the middle of lockdown, which was an interesting experience to starting a new business. We work very closely with Pareto Financial Planning. Stuart Carswell's on the call today. I'm sure quite a few of you might have met Stuart Craig in the past as well. So we're in the same office, which is where I'm based today in Manchester City Centre. We are a discretionary manager, which means that we manage people's wealth. And if we make a decision, we make a decision and we can make the change there and then. So, for example, if we decide today that we didn't like Tesco, we could sell Tesco for potentially all clients and go and buy Sainsbury's or whatever else. We're an appointed rep of a company called Thornbridge, which means that they do our regulatory hosting and work for us. As I mentioned, we're a discretionary manager based in Manchester, but we look after clients throughout the UK, and also we have a few clients based in Europe actually as well. So we do manage multi-currency portfolios. What do? We manage bespoke portfolios. So if you came to us and say, Alex, I have a particular ethical or need, which is becoming increasingly more common nowadays. The obvious one, please don't invest in any tobacco stocks or any alcohol stocks. Then we can do that. Equally, if you have no views in terms of where you'd like to invest, then we've got lots of views. So we can do that and tailor a portfolio which is appropriate for your level of risk, your level of income, your aspirations, etc. We do also manage portfolios for on a platform, so pooling assets together and managing it all as one. And finally, we have an AIM portfolio service which is for inheritance tax planning. So buying AIM companies that qualify for business property relief, which means that after holding them for 2 years, they're outside your estate for inheritance tax planning. Other inheritance tax tools are available, but that's just one tool which is used by a number of financial planners to mitigate that tax. And despite the fact that we are a relatively new firm, it's been a very successful year for us in lots of ways. One, the team is 10 strong, but we're growing. So we've got offers out for 3 people at the moment, and we're recruiting for another person. So the team will be 14 in the next 6 months or so. And assets under management have really exploded. We are up to 400 million assets under management in our first year. So hopefully by the end of this year, we'll go through a nice landmark of 500 million. So despite the fact that we're a relatively new business, we're doing very well because we've been doing this for a long period of time. And that is also been recognised by De Facto, who have said that we're an expert rated 5-star discretionary manager. So that's enough about me and Luna. Let's go into what's going on. Now, this has got two graphs on this chart. The top section looks at the amount of confirmed COVID cases that we've had. It goes all the way back to January 2020, when the pandemic really started in the Western world, all the way over to where we are today on the right-hand side. The top chart shows that we've had globally 181 million confirmed cases of COVID, which is quite staggering, the amount of cases that we've had. What I would say though is testing has clearly been ramped up significantly over the last 18 months or so. So we really don't actually know what the total number of confirmed cases are, but it's likely to be significantly higher than that. And the pattern over the last 18 months or so is that cases have gradually increased through the course of 2020. We then hit a peak towards the beginning of the year. Cases came down, and more recently they've been increasing and then falling again. So I've skipped on accidentally there. This very end bar at the end, it doesn't show that cases are falling off a cliff. That's not all of the data has come through yet, so there's more to come. As we know, the sad consequence of COVID is that not everyone gets better, and we're nearly at 4 million deaths globally. This is from the World Health Organization that have come through. And again, you can see the trend of deaths. There's a little bit of a lag compared to cases, which is crucial, and we'll talk about that when we talk about the UK shortly. But you can see, again, it follows a very similar pattern to the confirmed cases as you'd expect to see. Again, that chart is all the way back from the beginning of 2020 to as up to date as we could get it at the end of June. Where is that split? And I purposely focused today and started on looking at this global perspective, because we look very much what's going on in regional in the UK, and I spend a lot of time looking at what's going on in the Greater Manchester area at the moment for obvious reasons. But this is it's a global pandemic, and globalization has never been as strong as it is today. So it is very important that we think about what's going on globally. So again, that's why I've started and touched on that. This chart again is all the way back from 2020, and it just shows the different regional breakdowns and where the cases have been increasing or decreasing over this period. And quite astonishing, 2/3 of the cases that have come through have been individuals based in the Americas, North or South, or in Europe. So that's been the epicenter of the pandemic from China, where it originated. You can see that Southeast Asia did pick up meaningfully in April. And as we highlighted on the previous chart, cases really have been falling away. Unfortunately, that looks like that's going into reverse at the moment. Russia announced some new data this morning that their cases are picking up. In the UK, as we'll touch on in a second, we know that cases are picking up in the UK as well. So it does feel like this is going in the opposite direction. And this is quite an interesting chart as well, because it does show the impact that restrictions and lockdowns have had, because globally restrictions started really clearly in the spring of last year. However, we don't really know the true number of cases here. So if we look at it from 2021, you can see the restrictions that we've had globally, whether it be in Europe or in Americas, etc. You can see that restrictions have had an impact, and they have brought down a number of cases. I think there's always been a bit of a question mark about whether the impact is having if restrictions are having an impact or not. But it's clear to me here that they are having an impact, and we've seen that specifically within the UK as well. What is another key driver to what's going on is the vaccine rollout. So this chart is from when the vaccinations really started in December of last year. Israel was, as we know, very quick to get off the mark, and we're one of the quickest nations to roll out a vaccine. One of my own personal opinion, One of the things that the UK have done better than most in this and dealt with the pandemic slightly better is the vaccine rollout. And you can see there that the UK did steal a march across other nations in that January to April period. But then things started to peter out a little bit. As we know, there was a lot of political pressure in Europe at the time, and the vaccine rollout in Europe was lagging significantly. And that was one of the points that I made on our last call, that the vaccine rollout has been great in countries like the UK and US, but it's now starting to lag in Europe. But Europe has now started to really up its ante. They're getting more supply, and things have started to accelerate significantly there, which is great. The problem is, though, if you're looking at Mexico, the rest of the world, India, etc., it's still very low. The vaccine rollout still needs to improve significantly on where it has been, and we're really looking, as has been announced at the G7, till the end of next year, until kind of globally vaccinations are rolled out. So this is going to be around, and has been around for 18 months or so, but it's going to be around for another 18 months or so until we immunise the world. In the UK, we're in a very fortunate and lucky situation that the NHS has been so well prepared through its design, and also the fact that we, as a nation, had ordered more vaccines per capita than any other nation. So we have been very fortunate with that regard. Now, just to put some numbers on it and put some positive slant on this, there's been 2.2 billion vaccines that have been delivered globally, which is significant in a 6-month period. So there is some good news to be taken from this, that 2.2 billion people have been vaccinated with at least one vaccine. So I should have said at the beginning, this is just at least one dose. Clearly in the UK, we have a significant part of the population which have had more than one dose as well. So that takes into account these numbers as well. In the UK's case, just specifically, things feel like they're accelerating again after that April-May period where supply was a bit lower. And let's hope that everyone has a jab in their arm by the end of this month, and we can also look forward to Freedom Day, which has been delayed for 4 weeks or so, and we can then start to think about a world where we're not going to be without COVID, but we are going to be in a world where we can mitigate it as much as possible because we have the vaccines in place. And this is an ongoing situation. It was only announced this morning about the fact that the flu and COVID jabs are going to be combined in September for the over 50s. So there's, whilst we know that vaccines are helping in the short term, the longer term impact needs to be considered as well. So just bringing things back to the UK quickly, there was quite this data again is up to date as I could get it, and clearly things are changing very quickly. On the left-hand side, we've got cases. That is starting to pick up, as you can see from that red bar. There was 26,000 cases yesterday, which is the highest since late January. So this is a 7-day moving average. So you can see, if a 1-day figure is at the end of late Jan, then we're going to go back to these levels over the course of the next month or so. But what's really crucial, and as we know, is, well, what does that mean in terms of healthcare, in terms of supporting the NHS? And yes, there has been a pickup in patients that have been admitted over the last 7 days or so, and it's up 10% over the previous week. But what is going to be key for me over the next week or two, if not month, is that we know that there is about a 3 to 4 week delay from people testing positive to people having to go into hospital and then sadly dying. So what's going to be key is, have we really broken this link between cases and healthcare and situation and deaths? At the moment, it looks like that is the case, but it's still very early days with that regard. One interesting stat, though, that is worth highlighting is the average age of people that are testing positive. Unsurprisingly, that's fallen quite significantly. So at the beginning of the year, the average age of people that were testing positive was 41, whereas at the end of May, it was at 29. So you can see that the average age is falling because clearly the older critical 9 group have been vaccinated. Younger people tend to socialize a little bit more and having more interactions and contact with each other. So that's one of the reasons why it's picking up, and clearly schools have gone back and there'll be an impact from that as well. So at the moment, still positive in terms of the fact that you aren't seeing the NHS overwhelmed and you aren't seeing deaths picking up, but really over the next few weeks, it's going to be key to see if that is sustained or not. Now, we've touched on the global vaccine rollout. I just thought this was another way of seeing the number broken down in a different way and see how different countries are performing. And we talked about how well the UK have done, and Israel were very quick to get off the mark, but other countries are doing very well too. It's just they've got significantly bigger populations. So when you look at the likes of India and the United States on the right-hand side of this graph, you can see while significant progress has been made, but clearly they've got bigger populations to deal with. So the United States, despite being one of the biggest countries in terms of vaccinations, is not on the left-hand side. Percentage of the population is somewhere down here, and India again all the way down here at kind of 20% or so. So, but who knew Chile were doing so well? And clearly there's bits of Americas, which were highlighted earlier, where they have been impacted more than other nations. So it's encouraging to see other countries doing well too. What does all this mean? And this is a chart that I showed last time. The impact from COVID is very clear. You can see here on the left-hand side, the impact that you've seen to all global nations in 2020. It was staggering in terms of the impact that's happened to specific economies and the global economy full stop. China dealt with the crises, as we know very well. Their track and trace program was up to speed and up very quickly. They put restrictions in place and lockdowns in place very quickly whenever there is an outbreak, which has meant that they have been able to get back to their trend growth very quickly. I would say that we always have to be very mindful of the data that comes out of China, and there's some massaging that goes on there. So just, we need to treat it with a pinch of salt. Whereas the US, Europe, and the UK, as you can see in these different colours, UK in blue, where we're impacted with more. So the US was coming from a higher base, so it didn't fall as much. Restrictions in the US probably weren't as restrictive as they were in the UK and Europe. And the US has been quick to open up as well. And you can see that the US is bouncing back very strongly. UK and Europe, UK, as we know now, is performing better and bouncing back, and is likely to have a stronger 2021 as a function of the fact that we've rolled out the vaccine quicker. That being said, Europe is catching up very quickly, and growth within Europe is going to be strong this year as well. What does all this mean? Now, data from the OECD, the data from the IMF, the World Bank, etc., that doesn't really change that much month on month. So when I last presented, this data hasn't changed at all. Everyone is still expecting that 2021 will be a record-breaking year for GDP, and it's going to go. You have to go back all the way to 1976. So 45 years since the last time that GDP globally was above 6%. So it's still expected, and you're seeing it already, that 2021 is going to be a record-breaking year for global growth. And what's driving that? That's being driven by the fact that economies are reopening. Economies are reopening, and they're coming back from a low base because of the impact from restrictions have had. Consumption is a major contributor in the Western world, particularly in Europe and UK and US. And as we know, savings ratios have been very high. People have been able to save through this situation, more so than probably people are expected to do. which has meant that people are in a very strong financial situation. And as the economy's reopened, people have gone out and spent it, which is driving GDP higher. On top of that, you've got governments which are looking to support their economies and make sure that we really come out of the blocks sprinting. So the US are very close to unveiling a massive fiscal infrastructure bill, which would be very stimulative for the US economy. On top of that, we can't forget the US have also put $600 in everyone's pocket already this year in terms of trying to stimulate the consumption and the economy as well. So that you've already seen significant stimulus come through from global governments. Is this going to be derailed by interest rates going up? We'll talk about this later when we talk about the UK, but no. But the Bank of England and other central banks have been very clear that they want the economy to be strong. They don't want to cut it off with increasing interest rates. The Federal Reserve discussed this last week, that they expect 2 rate hikes by the end of 2022. So we've still got another 18 months or so of interest rates being low and supportive. And not only interest rates are being low, central banks are still in easing mode and supportive mode because quantitative easing is still going on. So there's a lot going on to support the economy. And my final point I'd make on this is companies. Companies have been very well managed throughout this as a kind of a mass generalization. Clearly different sectors have been impacted in slightly different ways, and I'm sure your own businesses have been impacted in different ways. And the way that I've because I like to keep things simple in my own head, is the way that I've been thinking about things is in the first half of 2020, when things really kicked off until June, everyone was in survival mode. Everyone was making sure that their business could get through, that their employees were okay. And then kind of slowly realized that the impact of COVID maybe has not been as bad as they first feared. They've been able to operate. And the economy gradually reopened in the second half of last year, and we've got a bit of a tailwind from that. The restrictions that have come since then over the course of 2020 and this year have not been as severe as they were. We as individuals have adapted, employees have adapted, and that's meant that businesses, in general terms, have come through this quite well. And I say in general terms because I look at the FTSE 100 and other global businesses, but companies as well as individuals are awash with cash at the moment. And it's people like myself are now going to those businesses and saying, well, you've done very well throughout this pandemic. You've come out of it and you're probably going to be more efficient as you're coming out. But what are you going to be doing with this excess cash? Because you're not earning anything in the bank on this cash anymore. So what are you going to do? Are you going to distribute it to us in dividends? Are you going to go and do some M&A activity? And really, as confidence has come back that the global economy is recovering, that's exactly what you're seeing. So, Morrison's was a very interesting development for us a few weeks ago, which to me highlights that, one, the world is still awash with cash, as we said. Governments have been looking to support their economies as much as possible, and quantitative easing does that. It puts monies in people's pocket. Companies have come through this mostly, as I said, in general terms, very strongly. So now they're now looking to do and make changes, which is an encouraging sign for the rest of this year and looking forward to next year. Private equity in the US is probably a prime example of animal spirits returning and life starting to return back to normal. So, conscious I've just been talking about what's been going on globally, and this is my favorite heart rate monitor of what happened in UK GDP, and just to highlight that we were in a very boring environment for 60 or 70 years. We didn't really realize it, and then 2020 came along and kind of blew all the records for the right and the wrong reasons. And you can see there the impact towards the second quarter when GDP fell by 20%, but then equally rose in the third quarter by 16-17%. Since I last presented, we've got another data point, which is this very last chart here, this last point here, and that highlights that GDP in the first quarter of this year fell 1.5%, which in hindsight is probably a very good result. The lockdown that we've been through the first quarter of this year is most similar to the period that we saw in Q2 last year, from the end of March to the end of June. And the two periods, despite having very similar lockdown restrictions, have created very different results. So you've gone from a -20 to a -1.5, which goes back to the point that I mentioned earlier, in that individuals, companies, we've all, in a sad way, got used to the environment that we've been in over the last 18 months or so, and we've adapted well. And that's meant that the impact to the economy hasn't been as severe as feared. We've also, since I last presented, the economy has gradually reopened, restrictions have been reduced, and yes, Freedom Day has been removed and it has been extended, and nightclubs aren't open yet, and we can't fully not socially distance, etc. But clearly the economy has reopened, and bars and restaurants are thriving at the moment. And I just anecdotally, I have mistakenly booked a restaurant on Saturday night when the football is on, months ago. And I booked this a month or so ago, and it was incredibly hard to get a table even a month or so ago, because everyone is looking to go out and enjoy themselves again. So, but the growth that we've seen from March, the growth that we've seen in April as the economy's reopened, it's been quite significant. So on a month-on-month basis, March saw the UK economy grow by 2.1%. April saw the UK economy grow by 2.3%. So you can see, as restrictions have eased, the economy is starting to now accelerate. And May will be stronger, and I'm sure June will be stronger again, and the second quarter will be probably up here in terms of what happened for the UK economy. So the economy is bouncing back very strongly, despite the fact that not all restrictions have gone yet. And that's just the UK. The UK is, as we highlighted earlier, ahead in terms of vaccination rollout. You're going to see this impact globally. So you're going to see it in Europe in the second half of the year. You're going to see it in other nations as their vaccination rollout increases, as restrictions are eased, that economies are going to boom. And that is principally, when you put all of them together, that's what's going to be driving those GDP figures on that chart there. So there you go, they're the numbers. Sorry, pop through. Now, it's quite an interesting day today because it's the first day that furlough companies are going to have to start to contribute towards that. And the furlough scheme, in hindsight, has been a fantastic scheme, which has really kept unemployment towards its lows. So this chart goes back to 1992, and it shows the main unemployment rate, which is currently only 4.8%. You can see in the financial crisis here, we got up to 8 or 9%. So historically, when you've had a recession, unemployment has been higher. I put this chart on purpose because unfortunately, society isn't equal, and you can see that the younger population are seeing increased unemployment at the moment. That being said, though, again, back to the financial crisis, that was running at 22%, and it's running at 13% at the moment because of the furlough scheme. So there's 28.5 million people employed in the UK, and there's 1.5 million people that are currently on furlough. And the furlough progress has been quite significant. So at its peak, there was 9 million people on furlough. So you can see how quickly it's fallen as restrictions are eased and as we've gradually reopened the economy. But that 1.5 million people accounts for 6% of the workforce. So what is going to be interesting now is, now that companies have to start paying towards it, and that gradually increases over the next few months, is what happens to that 6%. Do they come back into the employment and the workforce, or are they going to start to contribute to this unemployment rate? What I would say is, because of COVID and the fact that that you are seeing people having to isolate. And on top of that, there's definitely some inflation in wages at the moment. There's definitely a demand for labour out there. So that's a positive, that there is a strong demand for individuals. And you'd expect to see unemployment pick up, but I don't think that whole 6% is going to go on to the unemployment rate. I think maybe 1 or 2% will. So the unemployment rate's likely to pick up over the next few months for that factor. But as I mentioned, restrictions are getting eased, the economy is accelerating, and then you'd expect to go into this kind of normal trend as the economy accelerates, where unemployment starts to fall anyway. So expect unemployment to pick up over the next month or 6 months or so, but then expect it to fall down as people realise that the economy is doing well, and people look to rehire as well. Inflation. I mean, we could probably spend 45 minutes talking about inflation at the moment, because everyone seems to be wanting to talk about it. This is quite a short chart. It goes back to May 19, and it focuses on CPI, so consumer price inflation, not RPI, retail price inflation. And it just shows how inflation changes over time, and the different factors that are either positive or negative in terms of the contribution to inflation. Inflation at the moment is picking up. The Bank of England discussed it last week. It's the first time for a number of years that we've gone above the CPI 2% target, and we're at 2.1%. And the Bank of England also highlighted last week that they're expecting inflation and CPI to get to 3% in the next few months. So why is that happening? There was a number of deflationary forces which were caused because of COVID. The main one you can see here: clothing and footwear. The obvious one is transport costs, etc. Because of the oil price. You know, if you go back a year ago, the oil price was at $30. This is Brent oil. Today we're at $75. So the oil price has increased by 150% over the last year. And that impact is likely to continue over the next few months. And that's why you're starting to see a pickup in inflation, because of things like the oil price. But it's not just the oil price, and which is driving things higher. There's several contributing factors as well. Global supply chains are in tatters. There's container ships are all in the wrong location. The blockage in the Suez Canal. There's a number of factors, and COVID has meant that the global supply chain is being significantly impacted, and you're seeing shortages come through quite significantly. And you know, the law of economics means that if you start to see shortages of anything, then the price starts to go up. We've seen this in bikes. I'm not sure if anyone's seen Halfords share price, but Halfords have been going through the roof. Not just for the fact that they sell bikes, but you know, obviously everyone's been spending a bit more on their cars. But bike inflation is running at the highest price that it ever has done. So it's not just a question of oil and what's been going on there. On top of that, you've got a few other contributing factors coming through as well. There was a VAT cut last year, which brought down prices, which is now falling out of the numbers. And today that's back in. So there's clear impact from that. And Eat Out to Help Out scheme is going to be coming through in the next few months as well, where you know, there was contributing factors to that being artificially lower because of the VAT savings as well. So for a number of reasons, inflation is going to be picking up. Is that a concern? At the moment, I'd say no, but it's something that we need to be very mindful of, because everyone's talking about, is this transitory inflation or is this long-term sustained inflation? That's the big argument that's going on with economists at the moment. At the moment, it looks like, and most central banks are saying that it's transitory. And what that means is it's just these one-off impacts of VAT, it's this one-off impacts of a higher oil price, because inflation is an annual measure. It's looking at where we were a year ago, and we're looking at where we are now. And a year ago, we were in lockdown, and today we've got a nearly fully open economy. So there's significant differences there. And as that base effect starts to move higher, then the 2021 number will edge higher, but it won't edge higher as much. So that's why they're saying inflation is likely to accelerate, but then moderate afterwards. My own view is that we have more debt than we ever have as a nation, as a global economy, and it's very difficult for us to grow our way out of our debt levels. There's three ways that you can reduce your debt. You can either grow, you can either do austerity, as we tried to do in 2000, after the financial crisis in 2010 to 2012, and we know that didn't work and debt levels just accelerated. Or option three is to push the inflation button. And that definitely could be something that starts to materialize over the next few years. One, because individuals will see prices going up and they'll start to be knocking on your door saying, please can I have a pay rise? And that starts to be a self-fulfilling cycle that you start to see inflation creep higher. There are other factors that I'd highlight as well. I mean, I'd probably say we're maybe at peak globalization at the moment, and you might start to see some reshoring. And one of the massive deflationary forces that we've seen over the last 20 years is people moving production and factories to China and lower wage economies, which has been a massive deflationary force. But that feels like that might be coming to an end. And also, you're actually starting to see wage inflation in those nations as well. So it's not necessarily as cheap to be producing goods in these countries as it was in the past. That being said, demographics, we have an aging population. That is a deflationary force, as is technology. And the developments that we've seen in technology over the last 10 to 20 years has made us significantly more productive, which is deflationary as well. So the jury's out, but I would start to be prepared for higher levels of inflation, definitely over the next few months. The Bank of England has said that themselves, but potentially over the next few years as well. Which gives us a dilemma. Interest rates are the lowest they ever have been at 0.1%. I can't see the Bank of England increasing interest rates for another year. So that means that you're going to be having inflation running at 3%, but interest rates at 0.1%. So that's a massive gap. And being completely honest with you, a lot of the calls that we get nowadays are people that are sat in cash saying, what do I do, Alex? Whether that be company money or whether that be individual money, because national savings and investments are giving me nothing anymore. I'm getting zero in the bank. And I want to be generating some returns for my hard-earned cash. And that's exactly the dilemma that we're in at the moment. And it's definitely the right question to be asking. And this is one of the big consequences of interest rate policy at the moment is there's savers are being punished for looking after themselves because they're losing money in real terms if it's just being sat in cash. And as I said, if I expect inflation to continue to be creeping higher over the course of the next few years, then this issue isn't going away anytime soon. And the compounding impact of that is huge. So please, I mean, if you can take one thing from today, if you are sitting in high levels of cash, be thinking about what you can do with that. And that's why, as I said earlier on, you're seeing a lot of more dividends starting to be restarted from companies. You're starting to see more M&A activity because the fact that people realize that you can't sit in cash for long periods of time anymore because you're not earning anything on it. And kind of linked to that is the burst and acceleration that we've seen in the housing market. And as we know, interest rates and mortgage rates are very closely related. This just shows a 2-year fixed mortgage at a 60% loan to value, which seems realistic-ish now, considering how well house prices have done. And you can see that we are, as individuals, awash with cash for another reason. We're paying less on our mortgages than we ever have done over the course of the last 40, 50 years because of the fact that mortgage rates are hitting all-time lows. On top of that, we've got a banking system which is stronger and been rebuilt since the financial crisis. So banks are being more competitive and are willing to lend. So that's why this is happening. House prices are increasing at an astonishing rate. You're looking at double-digit growth, which is the highest going back for 10 years or so. But I think there's other factors to bear in mind. Like I said, back on the inflation numbers, just remember that people didn't really want to move a year or so ago. COVID has led to a lot of people just sitting on their hands and maybe delaying decisions for a period of time, as did Brexit, to be honest, as well. But you are starting to see average house price pick up, and we'll touch on a few of the other reasons behind that. But as we know, not all property are created equal, and not all regions are created equal either. And you're seeing different growth across different parts of the country. So this is from Rightmove. Rightmove have got a house price index, and you can just see kind of the impact that's being had on different regions. Sorry. So London. I'm not sure if we've got anyone on from London today. Sorry to be the bearer of bad news. You're massively lagging what's going on globally. Globally in the UK. The Northwest, where we're based, is doing very well, as is Wales and the Southwest. You're definitely seeing a lot of the strength is being driven regionally as people are looking for potentially more space. And there's definitely been an increase in 3 and 4 bedroom semi-detached, which is the hottest part of the market at the moment. And anything with a garden because of COVID is also done very well. So we haven't touched on one of the main reasons why house prices are doing very well, and that's clearly the stamp duty holiday, which came to a partial end yesterday. The 250, the 500,000 no stamp duty has now been reduced to 250. It's now tapered at 250 until the end of September. So we're expecting that house prices will continue to move higher. And that 250 is quite an important level because you can see it's just around what the average house price is according to Nationwide as well. So if the average house price or house sale going through will not have to pay any stamp duty till the end of September because it's still at that £250,000 level. It is coming to an end. It's not just the stamp duty holiday, it's also support for first-time buyers. Interest rates are going to continue to be supportive. As we mentioned, banks are willing to lend. Banks are lending at the cheapest rates they have done for a long time. You're seeing a return of 90%, 95% loan to value mortgages as well, which is a very stimulating factor for the economy. On top of that, we mentioned how strong savings ratios are, so people can afford to have a deposit for the first time for a period of time as well. So that's another positive. And now the fact the economy's reopened, that gives people confidence to go out and make it probably one of their biggest purchases that they can do in a house. So that's another contributing factor. Finally, I mean, Zoopla, I look at it regularly. I encourage you to take a look at it as well because it does give you an indication of what's going on in your own personal circumstances. It's not perfect. I think it's impossible to have something that is perfect in the housing market because each property is so individual. But it's worth taking a look at as well. And finally, we mentioned COVID having an impact, but I think Brexit's probably had an impact as well in terms of the housing market because since 2000 and the referendum 2016, people have been maybe a bit more wary of making big decisions because they didn't know what Brexit was going to look like. Whereas now, today, we know 95% of what Brexit's going to look like or looks like. The final 5% and what's going on with sausages, we're finding out at the moment. So there's clearly significant developments to be made over the course of the next few months as well. So I've been talking for about 45 minutes, which is bang on cue. So just a few concluding remarks. All the way back to the beginning, you are seeing cases pick up, which is concerning. But equally, to offset that, you are seeing the vaccine rollout increase, which has been, particularly in the UK's case, hugely impressive. And as I mentioned, something that the government have really got right. Other countries are catching up, but there's definitely significantly more room to be done globally in terms of the global vaccine rollout in emerging nations, particularly where variants are prevalent at the moment. As restrictions are eased, and as we highlighted for the UK, economic growth explodes. So economic growth in March was up 2.1%, in April was up 2.3%. It will be even higher in May, and it'll be even higher in June, because of the fact that there is a significant pent-up demand and cash balances there, which is being spent and stimulating the economy. Governments and central banks will not want to cut this growth off. They're going to remain supportive, which is another reason to be optimistic about the world. Infrastructure spending in the US will have a significant impact. Interest rates are not going higher, and that is clearly going to be draining some capital out, but when it does happen, but they're not going higher anytime soon. We haven't even touched on markets, which is obviously what I spend all my day and life doing. Stock markets move in anticipation of events, and we have seen very strong gains in stock markets since November. The US S&P 500 closed at an all-time high last night, hit an intraday high as well. The FTSE 100 closer to home has bounced significantly from the lows. And I was saying to Simon before this call, FTSE's up about 10% year to date, which is 6 months. In the second half of this year, I think it's easily possible that you can do 5%. But the purpose of saying that is that a lot of the easy, a lot of the quick, a lot of the cheaper money and the positive impact has already been felt. That being said, we're still positive. We just think that a lot of that money's already been made, and the impact will be less so going forward, to reflect the fact that valuations are higher and have moved significantly. It's not all good for all markets. Government bonds are under pressure, and that's principally a function of those inflation numbers that we touched on earlier. You get a very attractive return of 0.7% for investing with the UK government for 10 years, which is obviously better than you're getting in the bank. But when inflation's running at 3%, it's not the most attractive investment either. So inflation picking up is definitely having a negative impact on government bonds and cash assets. So I'm going to stop sharing now. Thank you all for listening to me present to that, and open the floor to questions.
Okay, thanks, Alex. I'll just stop